You know, when people invest in stocks or maybe even bonds, they know that they get what's called a holding period rate of return. Regardless of the currency in question, it's an amount as a ratio to the amount you put in. Now, some might think you get the growth rate of the firm, or others might think you get the rate of the firm achieves, taking advantage of its location, its styling, its patents, its innovation. And bless their little hearts, turns out they're both wrong. In fact, what you get, take the long perspective, you get back the discount rate, the return regardless, both for stocks and bonds. Let's start with bonds. Holding period return, you're going to get the next period return minus the amount you put in at, say, times 0, and the interest payment on the face value divided by the amount you put in, say, now. And we're going to do this, say, annually or periodically, if you like. Turns out it doesn't matter. And when you do the math, following all the way to the end, the return you get is the discount rate, not the interest rate. And here are some illustrative examples. No matter what the interest or coupon rate is, and various maturities, we calculate the bond to the next year and figure out what the return is. And it turns out in all cases, you got back the same return. Now, there is a heads up here, a caveat for bonds trading at a premium and having a call provision, in that you would more properly look to the call date and the yield to call, but still the argument remains the same. Now, of course, the more relevant consideration here is that of common stocks. Again, the holding period rate of return will be the next period price minus the current price plus the dividends divided by the current price. And if you substitute in the standard valuation model and the next period dividend, that's the current dividend plus 1 year of growth, and you make the substitution, the dividends cancel, you multiply through by the discount rate minus the growth rate, which gives you a rate of return not of the firm, not the growth rate, but the discount rate in all cases. Let's look at some examples. Here are stocks with differing growth rates, differing dividends, differing valuations, but they're all discounted at 10%. And we compute the next period dividend, the next price, of whether they rise, fall, whatever, and you always got back that 10% discount rate. And of course, to make this more complete, we should look at different discount rates where in fact the prices can or do rise or fall. And that starts with noting that dividends come from earnings, and it's times a payout ratio. That's 1 minus the retention rate. I'm using conventional notation here. And the earnings come from a rate of return on assets, noting that you get the earnings at the end of the period from assets at the beginning of the period. Likewise here, for most firms, not all firms, we have the growth rate being endogenously determined by the firm, by its retention policy, its payout policy, if you will, and the rate of return it achieves, again reflecting that location, patents, styling abilities, and so on. Here, we got a firm. All these examples start with assets at times 0 being 100. In all cases, the firm makes 12%, with 3 scenarios where it should have made 14, underachieving, or makes at the 12 specified, or would be happy to have made 10 but overachieves at 12. Likewise, now looking horizontally instead of vertically, we have different dividend policies, retention policies, reinvestment rate policies. On the first line, we retain nothing, pay out 100%. Well, that means 12% on $100 assets. That's $12 earnings. That's a $12 dividend. No growth. And the values are lower when the company should have done better. And likewise, on the right, when the company is now doing better than what it should, trades at a premium. But let's go down. As we go down each row, the amount of retention increases, the payout decreases, the growth rate increases, the dividends decrease. Now, in the first of the three right-hand columns, it should be doing better. It should be making 14, but it only achieves 12. And in that case, putting good money after bad, more reinvestment, lower dividends, higher growth, bad policy, the stock price drops. In the case of Modigliani and Miller, where the rates are the same, doesn't matter. And in the case on the right-hand column, the company is overachieving, should be making 10, but making a better 12, the price starts to rise when the dividends are decreased and the growth is increased. But let's stop for a moment and note a mistake a lot of even expert investors make. They confuse growth and profitability, thinking the growth causes profits. And if you look at the chart, that's not always so. But instead, its profits cause growth when properly handled. The so-called growth stock is an artifice of good policy and fortuitous situation in the case of the firm. Not the other way around. Growth does not cause profits. Profit plus good handling of dividends and reinvestment does. As an aside, as we're clearing things up, showing that both bonds and stocks have a holding period return of their discount rate, not the profitability, not the growth rate, not the interest rate. And something else is a bit confusing for a lot, and that is they think a high PE ratio is indicative of timing, but instead we're going to show it's just merely the reciprocal of the going discount rates. And if going rates are low, PE ratios should be high and are just. One can easily calculate a payout ratio. I actually have never seen this in a major investments book. You just multiply the dividend yield, that's dividend over price, times the PE ratio, and you get back the payout ratio. That's 1 minus the retention rate. And if you look at the PE ratio, and we've now disaggregated it and noted that we've substituted the growth as the retention rate times the profitability of the firm, that, well, normally you multiply it times the expected earnings and you get an expected stock price. That's what the analysts do. Of course, look at it in equilibrium. When K equals R, when what it should and what it does are the same, then it's thus the reciprocal of the going interest rate again. So while the vagaries and perturbations of the market are profound, and of course a diversified portfolio eliminates a lot of that, you realize that the return you get is that of the discount rate applied to the stock or the bond. Now, of course, those can change, and that's a whole nother discussion with Dr. C Invests.